Good morning, everybody. I'm Andrew Playle. I'm Head of Private Wealth at Mills Reeve, and welcome to the latest instalment of Private Affairs Comes to Life. Just a couple of housekeeping points for everyone. Today's session is being recorded, and those who have signed up to the session will be getting emailed a link to that recording and also a copy of today's slides. So the theme today is crypto assets, cryptocurrency, etc. And you're going to hear from three panelists drawn from our in-house expertise on digital assets. And I'm not going to go through everything that each of them are going to say, but you're going to hear from Ellie Milner, from Tim Whitney, and from Tom Filby, and they're each going to focus on different aspects of the topic. Their talk will last around half an hour in total, and then we should have 10-15 minutes for questions at the end, which I will chair. If you post questions using the Q&A facility, depending on how many questions, we might get through them all, or we might just get through some of them. I will choose who to put each question to, and I won't be naming who posted the question, so please be reassured that those attending remain anonymous. So thanks very much for attending. I'll come back to you towards the end of the session, and we've got a really good number of people who have signed up today, and I'm now about to hand over to Ellie Milner. Over to you, Ellie.
Thanks, Andrew. Morning, everyone, and thank you very much for joining us. As Andrew mentioned, we only have about 45 minutes this morning for our webinar, and there is just so much to say on this topic of crypto assets. I think we could easily fill our 45 minutes just talking about the various news stories from the last week or so. You may have seen some of those, and it's a subject that's developing really, really fast. So as I've only got about 10 minutes before I hand over to my colleague, Tim, I'm going to stick to the basics. So I'm going to look at what crypto assets are, how they're held, and what individual holders of these assets need to think about. So HMRC defined crypto assets as cryptographically secured digital representations of value or contractual rights, which is really just a very long-winded way of describing what are essentially secure digital tokens. And these tokens can take many forms. So they can be the cryptocurrency that we would generally recognize the names of, so things like Bitcoin and Ethereum. But the tokens can be used for many other purposes as well. So there's four main types of these tokens. So there's exchange tokens. These can be a means of payment or investment, and Bitcoin is a perfect example of an exchange token. A utility token, so this could allow access to goods or specific services. Security tokens, which give the holder some rights or an interest in something. And then there's something called stable coins, which are a bit of a kind of hybrid. They're pegged to fiat currency or to gold, so they're in theory a little bit less volatile, and you might use a stable coin actually to buy other types of tokens. So you might use your pounds or dollars to buy a stable coin, and then you use your stable coin to buy other types of crypto assets. So if we look specifically at the currency-like assets, so things like Bitcoin and Ethereum, these are usually purchased through an online exchange. So in the first instance, you might go online to an exchange and you can purchase these assets, or you might receive them in payment for goods or services. And these items are fungible items. So they're interchangeable and indistinguishable. One Bitcoin is no different to another. So in that sense, they're similar to a pound coin or a bar of gold. And then in contrast, you might have heard of non-fungible tokens or NFTs. A non-fungible item is something that's unique and distinguishable. So something like a physical work of art would be a non-fungible item. And so an NFT is a token that identifies ownership of a digital asset. And there's a ledger of transactions linked to the asset that prove the provenance of that asset and the ownership. And these NFTs can also be linked to real world assets. So the land registry, they've been reviewing the use of blockchain to speed up property transactions. But they're also looking at using NFTs to prove ownership of property. And NFTs can also be used to prove the provenance of physical items. So if you think of something like a designer handbag, for example, an NFT could be used to track the manufacture of the item. So show where the fabric came from, show where the leather came from, show the progress of the item being made. So it's a proof of the provenance of that item. So it could potentially be used to help combat counterfeiting and things like that. So NFTs can have real world uses. But if you contrast that with, there was an NFT called COVID Alien that sold recently for $11.7 million at Sotheby's. And it was just a 24 by 24 digital pixel head. And it sold for millions of dollars. And actually the most expensive NFT was sold just in December last year for almost $100 million. Again, something digital. So whilst there are these real world applications for NFTs, there are also these kind of slightly bonkers digital world examples of NFTs selling for huge amounts of money. But all of these items, so the NFTs, your cryptocurrency like Bitcoin, they all use distributed ledger technology. So this is a digital system that records the transactions in multiple places at the same time. So there's no central administrative or data store. So once a transaction has been validated in all of these multiple places, it can't be hacked or changed. It's there on the blockchain. And each type of asset will have its own blockchain. So there isn't a blockchain somewhere that has a jumble of, Bitcoin transactions and Ethereum transactions. They each have their own. And these ledgers are accessible to anyone. So if you wanted to go and, after this webinar, Google Ether blockchain, you can find a link to the Ethereum blockchain, and you can go look at that to your heart's content, and it will show you all the real-time Ethereum transactions. So while these crypto assets have a reputation for being secretive and used for criminal activity, and there's certainly an element of that, and my colleague Tom will look at that shortly, some of the main coins are actually really transparent. So there is certainly an element of genuine usage for these items. And I've just put on the slide there a note about the HMRC guidance. So HMRC has issued guidance on these, on crypto and digital assets. No specific legislation, but it's worth noting that HMRC is very clear that it doesn't regard cryptocurrencies such as Bitcoin as a currency from a tax perspective. It is most definitely an asset. Could I have the next slide, please, Tim? Thank you. So how are these assets held? The whole concept of this digital decentralized system of ownership means that ownership and access can't just replicate a typical bank type arrangement, because there's no central body anywhere that's actually regulating and managing these assets and transactions. And obviously there's no physical asset, so you can't, stuff it under your mattress for safekeeping. Crypto is held in what's called wallets. But the wallet itself doesn't hold the assets. So it's not like a little coin purse with all your Bitcoin in. The wallet actually holds the digital keys you need to show the ownership of the asset and to be able to deal with the asset. So to deal with the asset, you need a public key and a private key. And the public key is used to generate a public address. And other people can use this public address to send you crypto. So it's a bit like your bank account number. And then the private key is your digital ID to be able to use the funds, spend, withdraw them, a bit like your PIN. So basically, if you lose your private key, you've lost your asset. So it's accessing these keys that's essential to recover assets. And there are different types of wallet depending on how a person has chosen to keep these keys safe. So there's a hot wallet. So that's something that's online, connected to the internet. A cold wallet, that could be a USB drive, it could be a hard drive, it could be a piece of paper. or a hosted wallet. And these are held by a custodian or are hosted on an exchange. A well-known exchange is something like Coinbase, and it's reasonably straightforward to use, but because it's connected to the internet, there are just these inherent risks of hacking, which is why some people prefer to use something like a cold wallet that's more secure. But choosing how these assets are held and how you protect them causes some real headaches for people, because if they hold a significant amount, particularly, the issue of how you keep your private keys safe, but how you balance that with ensuring that if something happens to you, your crypto isn't lost, is a real conundrum. That it needs to be really secure, but fundamentally there needs to be a way that somebody else can access those if needs be. Which brings us neatly on to what happens to crypto on death. As a private client lawyer, this is something that I'm already starting to see with clients, something we're having to ask specific questions about when we're talking to our clients about wills and estate planning. So the average age of a person who is invested in crypto is 38. They're predominantly male, the majority don't have wills. So probably haven't even thought about succession or estate planning or what would happen to their potentially really valuable crypto on death. And there's an estimated $140 billion worth of these assets in lost wallets. So that's either because someone's forgotten their access details, they've lost them, or because they've died without leaving access instructions. And depending on how the person was managing their crypto, without clear and specific access instructions, the asset's just inaccessible, it's just lost. So if we go back to how these assets are held, if you don't have the private key, you don't have the asset. So when access is needed, where the information is stored dictates how easy it is to access. So an exchange like Coinbase, they generally have a process in place where somebody dies. So provided the people dealing with someone's estate know there is a Coinbase account, the process for dealing with that should be reasonably straightforward. But if a person's using their own wallet, how are the instructions going to be left for those assets to be accessed? How are the executors of an estate going to know where those assets are and how to access them? And there are online chat threads on this subject that go on for pages and pages and pages, because the fundamental issue is that there isn't an accepted way of dealing with this problem. And the options range from just leaving paper instructions, literally writing it down, although there's obviously clear security issues with that if you're writing down your private key, or there's incredibly complex multi-step processes that include passwords, encryption. Some people use a combination of paper and digital backups in case paper's lost or destroyed. I've heard of people giving different sections of their private key to different individuals. So you're relying on a group of people to get together to create that key. There's something called a dead man's switch, which is basically a computer program requires some positive action at set intervals. And if you don't fulfill that positive action, it will release access information to chosen people. And I've also heard of professional advisors holding private keys, which I think has some serious risk attached to it, given the potential value of these assets. Something that was worth very little 5 years ago might now be worth a huge amount. So, for a professional advisor to be holding a private key, that to me feels very, very risky. And I think something that, that we wouldn't be comfortable with. So a starting point is to have conversations with clients about what assets they have, where they're held. Are they on an exchange? Are they on a cold wallet? If so, where is it? How is the private key then going to be passed on? That's a separate matter to where where the assets are initially, and it's probably one primarily for the client to make a decision about, because it probably depends on their level of risk and what they're comfortable with. They may be very comfortable saying, I'm going to write it down on a bit of paper, give it to my executors, I trust them implicitly, but they may not. So it's probably a conversation to have, but actually ultimately a decision for the client. Valuation on death's an interesting point. Crypto assets are assets for IHT purposes, so would need to be valued on death for your IHT account. Things like Bitcoin and Ethereum shouldn't be too much of an issue valuing those because of the frequency of trades and the nature of the transactions mean there's historic valuation evidence that's readily available. Something like NFTs are going to be much more difficult. There's an element of hype potentially around these. There's a limited market, so you'd have to look at things like how many of the item is there. Are they linked to a real world asset of any sort? Do they have a use? Can it be used in an online game and therefore has value there? So I think you'd have to look at a range of things when valuing an NFT. But also when you're looking at these assets passing on death, if someone's left a specific legacy of crypto, that's fluctuated wildly in value, you can absolutely see that there might be challenges here about what that person genuinely meant to leave to somebody. What value did they think they were leaving? Because that could be really, really different to what the value is at death, particularly if they haven't updated their will and letter of wishes in some time. So, I've just put there as well, tax issues. There'll be people on this call who know much more about the compliance for crypto assets than I do, but there's certainly issues with people not being compliant. And, those could easily become apparent on death when assets are declared for IHT, but there's no record of any compliance during lifetime. So there's clearly issues on death there, but also what about something like loss of capacity? So if someone loses capacity during their lifetime, a process needs to be there to allow assets to be accessed. LPA is obviously a great starting point with maybe some specific authority in there to deal with crypto assets. But again, there's this access key that would be needed even if the authority was there. So some consideration to potentially lifetime access as well as on death. So lots of issues there to consider for private clients when it comes to holding and dying with crypto. But what if they get divorced? So I'll now hand over to Tim, who's going to take us through that topic.
Thanks, Ellie. That's provided a really helpful foundation. As Ellie said, I'm now going to look at this from the point of view of divorce and separation. The main piece of legislation for financial claims when dealing with divorce is the Matrimonial Causes Act 1973. And you can imagine that when this was being written, no one was thinking about how judges would grapple with Bitcoin or digital assets. And the progression of digital assets, even over the past few years, has been mind-boggling. I still can't really get my head around the fact that a video of someone setting fire to a Banksy is worth more than the original piece of art itself. But the main point I wanted to make was that this 1973 law is what applies to all assets, whether it's the house you can actually live in or whether it's the ownership of the first ever tweet. And the court has the duty to consider all the circumstances of the case, and one of the first factors they're pointed to is property and other financial resources, which would include digital assets and cryptocurrencies. So when clients separate, they're faced a number of options to how they deal with their separation. This includes processes like mediation, collaborative law, traditional negotiation by solicitors, or court and arbitration. All of these steps are based. All of these options are based on the same two steps, which are essentially the first step is what is there, and the second step is how should this be divided. And there's a duty on both parties to provide full and frank financial disclosure, which will include digital assets and cryptocurrencies. Financial disclosure is usually provided by the Form E, and there's a screenshot on the slide of the relevant section, which is section 2, part 5, capital other assets. And you'll note that this section asks for the value and then also the net value, so any tax or cost would be included. And what we found is that when talking to clients about their financial disclosure, it's helpful to remind them about cryptocurrencies and digital assets, because they may have dabbled in the past on the recommendation of a friend or someone that they spoke to down the pub, and then completely forgotten about it. And actually, over a period of time, the value could have dramatically changed. As Ellie said, some clients will hold cryptocurrencies on exchange accounts by online exchanges such as Coinbase and Binance. And these exchanges will allow you to provide reports and statements that can be downloaded as PDFs and then annexed to the Form E, which will provide evidence of the holding and the transaction. For clients that keep their cryptocurrency in wallets, either hot sort of online or cold offline wallets, then the disclosure they're going to need to provide is the address, their sort of wallet address. And what that will allow the other parties to do is go onto a block explorer such as Blockchair, and then confirm. That will help them confirm the contents of the wallet and the holding. it's always very helpful with the financial disclosure to consider the audience. So it's highly likely that any significant holding of cryptocurrency is going to result in a level of panic from the other side and from other lawyers. And in divorce terms, panic increases costs and it increases the delay of dealing with things. So where clients do hold digital assets or cryptocurrencies, it's always helpful for them to give us a full, clear understanding so that the other side can understand the asset and where it's held and the value of it. So including a narrative in plain English, assuming no knowledge, giving people instructions of saying, you know, here's the wallet address, go to a block explorer, and sort of take them through step by step is only going to be helpful. And so that's a sort of key thing, especially at the moment where the level of knowledge between clients is obviously very, very different. The other thing you can think about at an early stage is if your client's got very complex or very large holding, then it may be worth getting some expert analysis or independent analysis at the outset to provide a report that can then put it in terms of clients and lawyers, and potentially a future judge will understand. Although there's an initial cost for that, that it will likely save time and money as you move forward. So picking up on Ellie's point about valuation, as she said, most of the cryptocurrencies are traded online regularly, so you can get a daily price. At the moment, I think I looked yesterday, Coinbase has over 9,000 different currencies listed. The majority of those have no value, but I mean, that's obviously could change in the future at any point. The question of how should you value cryptocurrency as regularly as possible, I think is the answer you should get from family lawyers. The volatility is well known. I picked a currency at random yesterday, Polkadot, and looked at last year. And in 9 days, between the 15th of May and the 24th of May, the price went from £34 to £12.75, which is a variation of 63%. And then over 9 weeks, between May and July, it went down from 34 to £8.07, which is again a 76%. So in cases where you've got a significant holding of cryptocurrency, then this volatility needs to be at the front of mind at all points during the proceedings. Now, within the court process, the Form E is done at least 5 weeks before the first court hearing, and there's no requirement to provide updating disclosure before that hearing. You then have a number of subsequent hearings, and whilst there will usually be a direction that asks the client to provide updating disclosure, that will normally be 3 weeks before the hearing. So you can see the issues that can arise if you're at hearings, negotiating, looking to finalise financial settlements based on figures that are 2 or 3 weeks out of date. For a property value, that's not going to make a big difference, but for cryptocurrency, that could be a huge difference, and you could be negotiating on entirely inaccurate figures. So that's a sort of big headline point. There will, of course, be clients that seek to take advantage of the privacy that some cryptocurrencies can offer, and try to frustrate their spousal claims. This may be through just failing to disclose the asset completely, or it might be that they're deliberately vague or seek to benefit from the other party's gap in knowledge. So it's vital that clients, lawyers and advisors generally have a good understanding of the sector. A family lawyers network should now include financial advisors, accountants and other experts who specialise in crypto assets. And it's important to talk to the spouse about their partner's interest in crypto assets. What do they know about it? How do they think it's held? Do they think it's held online or offline? What's their spouse said to them? And the timing of when their spouse got involved or became active in this area can be quite helpful, because generally the longer they've been involved, the more sophisticated the holding might be. As part of the financial disclosure process, there's the ability to ask questions. When asking questions, you want to make sure that you are keeping them broad enough, so you're not limiting yourself to specific Bitcoin or Ethereum. You're talking about digital assets more generally and cryptocurrencies. It's also important to know the popular online exchanges, so that when you're going through bank statements, you can look out for the names of these exchanges, and potentially find the start of the trail. The Form E gives you 12 months of bank statements for each account, so that's a good starting point. And if it's justified, you can ask for more statements. Again, experts, Where proportionate, you should involve experts. They have the experience in tracking and tracing and recovering these assets that will complement the questions that you're asking, and potentially any future court involvement. They're also very good at producing reports and diagrams that will make information accessible to everyone. And Tom will deal with this a bit more later. And then the ability to take an injunction to try and freeze the asset is also an option. Obviously, if you're proceeding down this route, you need to be very clear as to what you're actually asking the court to do. How is the currency held? Are you seeking possession of any physical hardware or USB drives? And you'll also need to consider the location of the online exchanges and their likely compliance with any order that you get to make the piece of paper worth anything. Again, taking specialist advice from counsel who've got experience in this area is key. And as I said, Tom's going to look at this from the point of view of his fraud case, but there's a number of principles that are relevant to family cases. And then finally, the court do have the ability to draw adverse inferences against another party if they find that they're hiding assets, and that can lead to a higher reward. As with anything in the realms of injunctions and experts, this all has to be viewed through the lens of proportionality, necessity, and doing a cost-benefit analysis with the client. And then implementation. So when considering how to deal with cryptocurrency on settlement, it's vital to have a detailed understanding of your client's position and their attitude to digital assets. This will commonly involve working with their financial advisor to ensure that the client understands the benefit and the risk associated with the assets, and just to see how it fits in with their general investment strategy. The safest option is often to share the assets in specie, so on a percentage basis, but this does require both parties to be comfortable and to be set up to hold cryptocurrency. If digital assets are being offset from more traditional assets, then again, making sure that the client understands the risk associated with the price volatility and trying to keep the timing between the valuation and the completion of the transaction as short as possible. It's also important to consider the enforceability of the order. So we always want to try and avoid having to come back to court to ask for the order to be enforced. And so with cases of larger holdings, you can try and build in some protection into the order by making the crypto transfers concurrent with transfers of other assets and try to provide some leverage which should incentivize the compliance. So that's my whistle-stop tour. I'm going to pass to Tom, who's going to talk to you about a much more interesting topic of scams, Ponzi schemes and fraud.
Many thanks for that, Tim. I'm not sure it's going to be that much more interesting. You've set the bar high, but I'll do my best. As Tim said, and others, I'm Tom Filby, a litigation and insurance partner, obviously at Mills Reeve, and I've got the pleasure of speaking to you today about when crypto meets crime. So financial frauds are a significant part of my practice, and in particular the tracing, preservation and recovery of stolen or extorted assets. Crypto is increasingly becoming part of cyber-related fraud, and that can range from high net worth individuals being duped into investing into Ponzi schemes, right through to businesses that have crypto assets that fall victim to phishing scams and, I suppose, classic wire frauds. There is a perception that hopefully I'll debunk, that criminals can navigate the world of crypto entirely anonymously and with impunity, but that's not necessarily the case. Law combined with technology means that stolen crypto can be traced, preserved and hopefully recovered. The first key to unlocking this potential has been the legal characterization, as we've already discussed, of cryptocurrency as property, in spite of it being an entirely intangible asset with its value principally anchored to concepts of supply and demand. Turning to the law, for those that are interested, the status of property was first established in an unreported decision by the UK or the English court in Robertson and Persons Unknown, and that was in 2019. And that followed a spear phishing attack against the CEO of a crypto fund. And that resulted in around 80 Bitcoin, I think, being transferred to a fraudster's wallet and eventually traced to a crypto exchange based in the UK. The court was prepared to grant an asset preservation order effectively over that wallet within the exchange that preserved the Bitcoin that was still held within it. And effectively, that operated in the same way that we can traditionally do in respect of, let's say, fiat currency or traditional funds within a traditional bank account. That view of crypto as qualifying property was obviously further confirmed by the UK's jurisdiction task force around the same time, and its statement on the legal statement of crypto assets that recognised digital currencies as capable of representing property with enforceable proprietary rights, and therefore proprietary rights enforceable before the English courts. Just going through some of the other sort of case law very briefly as well, just because it illustrates the kinds of frauds we're dealing with. Almost sort of at exactly the same time, there was the other case of AA and persons unknown. This time it was an action brought by London market insurers, and that was in respect of Bitcoin that had been paid following a ransomware attack. And that was crypto traced to an exchange in the BVI. Again, the court granted a freezing injunction against the persons unknown that held that account with the crypto exchange, but the court was not prepared to order a disclosure order against the exchange on the basis that it was based outside of the English jurisdiction. But in the subsequent case of Iron Science and persons unknown, and you can look at all these cases at your leisure, and you can see them on the slide, the court was persuaded that it could order a disclosure order outside of the jurisdiction against the decades-old and probably long forgotten bankers' trust order regime. And finally, most recently last year, we ourselves have been involved in a case that effectively drew together all of these different strands, and we successfully obtained both a disclosure order and a freezing injunction and proprietary injunction in respect of extorted Bitcoin that was traced to an exchange in the Seychelles. That particular matter that we were involved in related to an individual that had begun to dabble in cryptocurrency trading using the operating profits that he had channeled through an offshore company in the Isle of Man, which I expect will be a sort of a similar setup that many of you deal with. A phishing email scam effectively led to his Bitcoin being wrongfully misdirected to a crypto wallet belonging to a fraudster. We were able to trace the Bitcoin through various private wallets until it finally reached a deposit account within that Seychelles-based crypto exchange. So you'll note from all of this that I keep on mentioning crypto exchanges. And you'll see on the slide, to try to illustrate the importance of that, there's a fraud scenario. So, I mean, I suppose effectively take the scenario I've just explained, or a similar one where you've got an owner-managed business that's effectively been duped into paying funds, to paying its sort of Bitcoin assets, or crypto assets to a crypto wallet that belongs to a fraudster. So you'll see in the diagram here that you've got 2 Bitcoin that was sent from the company's wallet to the fraudster's wallet. The fraudster then splits that Bitcoin in 2 different directions and retaining a small portion itself. Following that, you'll see at the sort of top of the screen, you've then got a payment that goes out to other third-party wallets. So it kind of hops on to more private wallets. And probably some of that just goes out into the ether, and we just lose kind of track of it, or the numbers become too small to really worry about. But you'll see that some of it hops from one third party. You've got 0.8 Bitcoin going into crypto exchange, a particular deposit account there. Similarly, if you look at the bottom kind of strand and stream, you've got further payments to third party wallets. Then you've got this sort of pattern where funds are passing between these private wallets, but effectively just in a circular fashion. And they come back to a particular wallet, and then they're sent on to the same deposit accounts with the same crypto exchange. And it's that sort of pattern of transactions, which surprisingly perhaps is not that uncommon. Not all criminals are that sophisticated. It's a reasonable assumption that the deposit account within the exchange is likely to be the deposit account belonging to the fraudster, or at least someone who's a conspirator in the fraud. The deposit account here is key, because it's not until crypto hits a deposit account within an exchange that it's possible to meaningfully obtain a disclosure order or freezing injunction, or deploy some other kind of mechanism to seek to preserve and recover assets. This is because a private person's crypto wallet, so the third-party wallets on the slide, are actually pretty anonymous. And the tracing stolen crypto through those wallets won't really help you in terms of identifying who is the owner of those wallets, or in turn obtain any injunction with any meaningful prospect of enforcement. However, keeping crypto in a private wallet is not a long-term solution. At some point, it's necessary to cash out that crypto. So, I mean, after all, even criminals they need cash, convert into cash to do the grocery shoppings for their grandmothers. And in order to cash out that crypto, you need to open an account with an exchange, and then you convert your crypto into pounds or dollars or euros or whatever it is, and send it to a linked account, which will be a traditional high street bank account, so that you can then spend that money. And it's at that point, when the funds hit the exchange, that the opportunities for discovering more about the owner of the deposit account and who might be behind fraud opens up. The vast majority of exchanges these days are striving for legitimacy, and they've got stringent due diligence KYC requirements, including obtaining proof of identity of their account holders and obtaining details of their related traditional bank accounts. And you also have many exchanges, whilst there is no sort of, let's say, sort of central regulatory body, they are voluntarily submitting to the oversight of the financial regulators in each of the jurisdictions in which they operate. So what this means is that many of these exchanges hold valuable and reliable information on the crypto account and the account holder to which stolen or extorted assets are traced. And effectively, what we are often looking to do is to compel those exchanges to provide disclosure in respect of those accounts and the account holders, much in the same way that we have done for many years with traditional banks that receive traditional stolen funds in pounds and dollars and euros. At this point, you can get a freezing injunction, and that should prevent the further dissipation of any assets. But it's from the disclosure that I've just mentioned that in particular, you get a fuller picture that ought to emerge as to the characters involved, their assets, the status of the funds, from which much better informed decisions can then be made around the recovery options. And I mean, for our clients, that may well be, including making a decision that no further action is justified, but doing so with the comfort that no easy recovery option has been passed up. How we trace through to those exchanges is where the technology aspect comes in. So over the last sort of 2-3 years, we've developed relationships with the likes of the US-based crypto business Chainalysis, and with specialist investigators that use software that Chainalysis has developed, and that software that's been mentioned in some of the cases mentioned earlier. That software effectively maps out the path that any crypto takes, a bit like I think as Ellie mentioned before, you can sort of, or maybe Tim, you can look up on sort of blockchain.com and you can follow crypto. But what you have is just a sort of obscure lines of random characters and numbers, and it doesn't tell you very much. But the Chainalysis software effectively attributes a label to certain wallets and accounts, and in particular those that are associated with crypto exchanges. So, I mean, on the next slide is an example of what this software looks like, and this is in the context of a fraud that we've actually dealt with. And you'll see here that there are 3 transactions that were made by the client, by the victim, to a fraudster's wallet. And again, as you saw from the sort of previous slide, you've got these private wallets in the black dots where funds have been pushed on. But eventually, we can trace those funds through. We don't know who owns these private wallets, but we can trace some of the funds through to exchange number 1, as you'll see on the slide, but almost nothing has gone there. So there's an inference that it's unlikely to be implicated with the fraud. But exchange number 2 has received a very large percentage of the original funds stolen. And we can identify the identity of exchange 2 using the software that Chainalysis has developed. And from that, we can start making inquiries direct with that exchange. And we can also go to the court and say, we believe that the deposit account holder, who is the owner of that account with the exchange, or is the beneficiary of it, is on the evidence that we present here, likely to be part of the fraud. And that will in turn help provide an evidential pack before the court to justify the injunctive or disclosure relief that we are seeking. Of course, this is not all plain sailing. Aside from this, and there are sort of few challenges. So Tim, you can just forward on the slide. There's obviously development of technology, development of law. The criminals are developing as well. As we become wise to their tactics, they become wise to ours. There are also a number of technical issues and challenges that have to be navigated in all of this. Some of these are identified on the slide. In the interest of time, I realise we're probably sort of over our time already. I don't propose to delve into them. But they include, very briefly, you've got jurisdiction and choice of law considerations. So, for example, where the loss or damage is suffered and which courts can be seized of the matter. We've got the issue of whether any orders that we obtain, let's say out of the English court, whether they need to be domesticated before local courts, before enforcement. So that might be the local court of the exchange. And whether an exchange will even comply with such orders. So typically Binance, in spite of how big it is, and it didn't used to, I think, sort of necessarily sort of comply, but that has changed as the regulator has put increasing pressure on it. And even if there is compliance, is the reliability of the KYC from crypto exchanges reliable? Is it good? So it's not plain sailing, but there is certainly the legal and technological basis for which to seek to tackle crime when it arises. So, I mean, just in summary, really, as I think we've heard today, crypto is obviously gaining mainstream popularity. And I think we all agree that it's likely to become an increasing feature in business and in private affairs, from tax, as Ellie described, right through to crime. And understanding the key aspects of crypto and the legal and technological environment in which they operate is becoming ever important. I'm hoping that we have at least managed to shed some light on this exciting area, albeit within a short space of time, given the breadth of the topic. And with that, I hand back to Andrew.
Thank you very much, Tom. Thanks also to Ellie and Tim. We're just going to use the next 10 minutes for those who can stay, just to get through a few questions, perhaps just one for each speaker. Bear in mind that you will get a recording of this, and it will include the Q&A. So one question I've been asked, which I'm going to put to Tom, is the questioner says has been puzzling them for some time is, if there's such visibility around crypto transactions, why do law enforcement agencies not see the transactions that are made by criminals, drug smugglers, etc.?
So actually, they do see them, and I forget when it was, but there was a press release in sort of BBC News a few months back where the Met Police, and I've met their crypto task force in the past. It was something like an £80 million crypto bust relating to money laundering and the drugs trade. They do have visibility, and again, they will use the same kind of Chainalysis software to effectively wait until they see what they consider to be sort of proceeds of crime. They wait until those crypto assets work their way through to an exchange. And they will do a very similar thing to us, I imagine, which is to obtain disclosure orders to find out more about the owners of those accounts with the exchanges, to build up an evidential package. I think there are criminals out there that will launder money through crypto assets, but then push them on through so many private wallets that just trying to unpick all of that and demonstrate to a court that even though you've got 20 or 30 hops through which the funds go before they hit an exchange, that they are all wallets implicated within the same fraud. And evidentially that can present challenges, but equally it has provided the tools for the likes of the Met Police and the FBI to take down crypto gangs. And one would expect that to be happening with increasing regularity as law enforcement becomes increasingly familiar with that sort of form of technology.
Thank you very much, Tom. So we've got a couple of points which are related to Ellie's part of the talk. The first one I'm just going to deal with very quick myself, which is, just to be clear, are we saying that crypto assets are part of someone's estate from an IHT perspective? And the answer to that is yes. Ellie, we've been asked some questions, similar questions about the use of crypto as assets in trusts, and what our thoughts on that are, what points might that give rise to?
I mean, fundamentally, there is no reason why crypto assets couldn't be held in a trust. I think probably more important are the questions about whether they should be held as a trust investment. Trustees have a duty to make investment decisions and take advice on those decisions and manage the risk. And I given the, if you look at something like Bitcoin, the volatility there, the tax implications of that volatility, I think there'll be questions around whether that was a suitable trust investment. If a trust was specifically set up to hold crypto and there was a very clear mandate for that, that might be one thing. But I think a typical, your typical family succession trust, I think the trustees would have to have some really robust advice and a good diversification if they were looking to hold crypto.
Thank you, Ellie. A quick supplementary question for you. Let's go outside the trust sphere. Imagine assets are directly owned now. Are they subject to capital gains tax, income tax, etc.?
Yes, and yes is the very easy answer. The taxation is a little bit fiddly because of the way these assets work, because they are assets and not a currency. And there are ways in which you can use these assets to create interest, which leads into income tax. So yes, they are subject to tax, capital gains tax, income tax. The HMRC guidance is very useful on that point, but it is pretty complicated, and there can be really quite unexpected outcomes where people have big tax liabilities and actually no value left.
Thank you, Ellie. I've got a question for Tim now. It's really a question about your experience and your team's experience of the level of family court judges' understanding of crypto and how that impacts on getting permission to do certain things like inquiries, expert evidence, etc.?
So I think it hugely varies, and you, because you don't know your judge until the day before or sometimes the day of, I think you have to approach on the basis that there will be no knowledge. Anecdotally, I think it depends on, you know, the judge's personal interest in the topic. Often deputy judges who are also still practicing as barristers will have a better grip than full-time judges. But if it forms a key part of the case, then I think you have to come prepared that there will be no knowledge in the court and that you have to bring it with you. And certainly one of the agencies that we work with do a very good glossary and sort of explanatory document that I think should be part of your case, or something similar to that being part of your case before you get there, so that the judge has had the note the day before and has had the chance to read it and sort of caught up with everyone else.
So it's very varied, but perhaps you expect the worst and then hope for the best in terms of what the actual level of knowledge is.
Yeah, that's our mantra. Expect the worst.
Okay, so we do have a few more questions, but given timings, I'm going to call things to a halt now. Thanks for everyone for attending. We have just a little under 200 people attending today, so that's really excellent. Clearly, it's a topic that's of great interest to people out there. Thanks again to our panelists, and hopefully see you all next time we run a similar session. Thank you. Goodbye.